I'm Anna Nichols, Director of Communications here at Altair Advisors, and I'm joined today by Jason Laurie, our Chief Investment Officer. Welcome, Jason.
Thanks, Anna. Glad to be here.
Well, to get us started, it's been a very volatile autumn in the markets. What are our takeaways on all the ups and mostly downs?
Well, it certainly has been volatile. Unfortunately, volatility is a normal part of investing. In fact, the S&P 500 experiences a 10% pullback, similar to what we experienced in October, roughly once a year. But what separates a normal volatile market from a much more serious bear market is a recession. Long-lasting bear markets coincide with recession. And despite the 10% pullback in October, we still believe the probability of a near-term recession is low.
What informs our view that this economic cycle will continue and that a recession in the near term is unlikely?
Well, we pay close attention to many macroeconomic data points, including the leading indicators, which help us look to the future. And they currently show that most sectors, aside from the softening housing market, remain strong. As an example, the Conference Board's index recently posted its best number in 7 months. So the evidence we monitor suggests that the U.S. business cycle remains on a growth path heading into 2019.
We're hearing more questions from clients about China. So far, the U.S. economy has not been significantly hurt by the trade war with China. When will it meaningfully affect both the global economy and markets?
Well, the trade war with China has been the darkest cloud hanging over markets this year. And as you suggest, up to now, it has had limited impact. As an example, corporate earnings have still been strong. We saw that in the third quarter earnings season. However, we are seeing more U.S. companies issue warnings about their future earnings. The fact that their earnings will be negatively impacted if the trade war isn't resolved. Our view is that we still expect a negotiated resolution to end the trade war with China, especially now that China is under more pressure with its struggling stock market and its softening domestic economy.
Another common client concern, rising interest rates. The markets expect that the Federal Reserve will raise rates again in December, the 9th increase in 3 years. What risk do these continuing rate hikes pose?
We believe that the Fed can continue to normalize rates and again hike them in December without halting economic momentum. As long as growth continues and the Fed remains data dependent, the economy can handle higher rates. However, we would be concerned if the Fed were to remain on a rate hike path into next year in the face of a weakening economy.
Well, thank you for joining us today, Jason, and sharing your insight.
Thank you.
And thank you for being with us. And to see our full commentary, please visit our website.